Welcome back to our channel. Today, we're diving into the world of finance to explore some essential financial ratios that every investor should know. These ratios will help you evaluate a company's performance and make informed investment decisions. First, let's quickly define financial ratios. These are quantitative measures derived from financial statements, used to assess a company's operational efficiency, liquidity, profitability, and solvency. Now, let's break down the most important ones. 1. Current ratio. The current ratio measures a company's ability to cover its short-term liabilities with its short-term assets. A ratio above 1 indicates that the company has more current assets than current liabilities, which is a good sign. Formula: current ratio equals current assets, current liabilities. 2. Quick ratio, also known as the acid test ratio. The quick ratio is similar to the current ratio but excludes inventory from current assets. This gives a clearer picture of a company's immediate liquidity. Formula: quick ratio equals current assets, inventory, current liabilities. 3. Gross profit margin. This ratio indicates how efficiently a company produces its goods. A higher gross profit margin means a company retains more profit on each dollar of sales. Formula: gross profit margin equals gross profit, revenue, x 100. 4. Net profit margin. The net profit margin shows how much profit a company makes for every dollar of revenue after all expenses are deducted. A higher net profit margin is usually a good indicator of financial health. Formula: net profit margin equals net income, revenue, x 100. 5. Return on equity. ROE measures how effectively management is using a company's assets to create profits. It's particularly useful for comparing profitability across companies in the same industry. Formula: ROE equals net income, shareholders' equity. 6. Debt-to-equity ratio. This ratio compares a company's total liabilities to its shareholder equity, providing insights into the company's leverage and financial risk. A lower ratio typically indicates a more financially stable company. Formula: debt-to-equity ratio equals total liabilities, shareholders' equity. 7. Interest coverage ratio. This ratio indicates how easily a company can pay interest on its outstanding debt. A ratio above 1 suggests that the company is earning enough to cover its interest expenses. Formula: interest coverage ratio equals earnings before interest and taxes, EBIT, interest expenses. 8. Asset turnover ratio. This ratio measures how efficiently a company uses its assets to generate sales. A higher ratio indicates better performance. Formula: asset turnover ratio equals revenue, average total assets. 9. Inventory turnover ratio. This ratio shows how often a company sells and replaces its inventory over a period. A higher turnover rate indicates efficient inventory management. Formula: inventory turnover ratio equals cost of goods sold, average inventory. Understanding these financial ratios can empower you to make smarter investment decisions. Remember, while ratios are powerful tools, they should be used in conjunction with other analysis methods and industry benchmarks. If you found this video helpful, don't forget to like, subscribe, and hit the bell icon for more financial insights.